Once you realize that you can create that success in real estate, it's hard to get as excited about turnkey acquisitions. And that's what really kind of shaped my backbone or experience in being a value-add investor. And then you just add almost a 20-year runway to that, and you're just scaling up the whole time. I mean this with no offense to any real estate investor, but usually a value-add asset is value-add because the asset's tired, and the asset's tired because the owner is tired. I have been a big fan of acquiring properties that are below average and repositioning them to average. And there's a lot of takers for average. That's just part of the art and the juggle of working through value-add acquisitions.
Hey everyone, welcome back to another episode of Commercial Connections, Investing with Confidence. I'm Rene, the producer of the show, and today we have a super special guest with us, Logan DeVos. Logan started as a broker in 2007 before he could even legally buy a drink, but that didn't stop him from making big moves. Today, he's the CEO of SMI Fund Management and owns $81 million commercial real estate portfolio spanning multifamily, office, retail, self-storage, and development along Oregon's I-5 corridor. His philosophy: if you can't drive by, don't buy. Known for spotting underperforming assets and turning them around, Logan's expertise in market cycles and risk mitigation, shaped by investing through the Great Recession, helps him decide when to buy, hold, or sell. Since retiring his real estate license in 2001, he's fully embraced the investor mindset, building strong partnerships and staying laser focused on long-term growth. Leading today's conversation is your host, Rene Nelson, an award-winning CCIM in the Eugene, Oregon area who's spent years helping investors grow and refine their portfolios. Before we dive in, welcome. Thanks, Logan, for being here.
Thank you for having me. Looking forward to the discussion today. Rene, it's good to see you. Brittany, it's nice to meet you.
It's good to see you, Logan. We go way back. I'd love to ask you some questions. What sparked your interest to get into real estate at such a young age?
I'll say that I was fairly entrepreneurial from a young age. My brother and I started in the chicken egg business when we were in middle school. As we got older, we got into paintball, and we opened several paintball playing fields, retail stores, and we ran a West Coast competitive tournament series and had a distribution contract for a brand called Nightcap Paintball that we sold to retail and playing fields up and down the West Coast. One thing I learned through that experience and inspired me to pursue real estate is that industry I perceived as having a real ceiling. And if you excelled in it, you could run a great bricks and mortar business, but it was a challenging industry. You could kind of see where that ceiling was. And as I looked around at what other people were doing and I learned about real estate, I was very much attracted to it because I realized that if you excel in that industry, to a certain degree, the sky's the limit. There's no ceiling on it. And that is kind of what inspired me to start walking down that road at a young age.
Wow. So your portfolio is valued at 81 million, which is really impressive. What strategies have helped you to scale to that level?
So I got licensed in 2007. I had worked as a transaction coordinator for a RE/MAX office locally where I grew up in Philomath. I quickly fell in love with commercial real estate brokerage and was very much interested in investing in income producing real estate. My older brother, Trevor, is my business partner in our real estate holding company. And coming up through the Great Recession, I think is a common occurrence when people get into real estate. The first thing you're going to try is flipping a house. And there's a lot of literature out on that, a lot of books, a lot of real estate gurus, some of it legitimate, some of it illegitimate. It takes you a little bit of time to work through what's right and wrong. So our first acquisition was a single family home. And during that period of time, we were looking at single family homes in Albany and Lebanon and Salem in the sub $50,000 range. So we made our first acquisition. We learned how private money and hard money works. And I'd read the books and we utilized high amounts of leverage, and we're going to improve this property and then sell it and make a profit. And as we worked through that, we realized that there was another opportunity, and that was to influence the value of the real estate through physical improvements and repositioning those assets to create an equity position. And you could sell it and realize your profit, or we could put a resident in it and turn it into a rental property and go for a refinance event. So I kind of learned through just trial and error what they now call the BRRRR strategy: buy, renovate, re-tenant, refinance. And we had to focus on value add acquisitions, because if we didn't create a 25 or 30% equity position, we couldn't hold the property. We didn't put a down payment on it to start with. And so that was kind of a trial and error of how that business cycle on an asset works, and that you can influence, that's what a value add acquisition is, or at least in my mind, it's an asset that you can directly influence its value. You can participate in the value chain and drive for an increased equity position. It was really a means to an end. And we started with single family homes. As you get a couple of those under your belt, we realized, well, 2 to 4 unit properties have a better income multiple. They provide a better yield than single family homes do. And we followed that kind of organic maturity as an investor. And we started then purchasing 2 to 4 unit properties, and we just continued to upleg from there. So to answer your question, Rene, for me, I was kind of forced to learn that process and how to excel in identifying assets that we could influence the value on. It quickly morphed into dealing with income producing assets versus single family homes. The value of a income producing asset is a direct derivative of the asset's income producing capacity. So that's when I started to kind of get my arms around how you create value and how that's directly tied to the increase in the net operating income that you're producing. And over time, our portfolio slowly snowballed, and pretty soon we've built equities and we're getting organic appreciation from the marketplace. But old habits die hard. So once you realize that you can create that success in real estate, it's hard to get as excited about turnkey acquisitions. And that's what really kind of shaped my backbone or experience in being a value add investor. And then you just add almost a 20-year runway to that, and you're just scaling up the whole time.
Okay, so I'm going to ask you a couple of questions for the audience. How old were you when you did your first one? Tell me again, were you 18-ish?
I believe I was 19 years old when I made my first acquisition.
Okay, and you mentioned 50,000-ish price range. If you were to buy that same house today, what would the price be today in the rough condition?
Yeah, I mean, I can pull them up in Redfin. I used to do that just out of curiosity. It's been quite a few years since I have, but I would guess that those homes are all 200,000 plus today. There were certainly what I would consider, entry-level housing. These are 1,000 square foot vintage homes, usually built in the 70 to 90s era in tertiary markets of Oregon. So always the properties that we're looking for, because entry-level housing creates for a better rental portfolio in many ways. As far as the gross income multiplier is a lot lower than if you're dealing with a higher end home. So these homes were probably always below average in the price point of the marketplace. But with where housing has gone, I wouldn't be surprised if these homes are even pushing 300,000 plus today.
Since you've used it in the past as a tool, talk to our listeners about the gross rent multiplier and just how you use that as an investor. Because I know a lot of people who buy 1 to 4 family units, it's a quick back of the napkin tool to use. So talk about the gross rent multiplier and how you use that when you were looking at properties.
Yeah, I found, and even, put this into a little bit of context, and I retired my license, as you know, my real estate broker's license in 2001. And, my client base almost exclusively had never invested in real estate. And so I, being a young guy on the block, was kind of starting with finding new investors that wanted to invest in real estate. And we kind of all rode the same life cycle together. So back in 2009, 10, and 11, they were buying single family homes. Then we switched to plexes. Then we switched to 20 unit apartment complexes. And we ultimately made our largest acquisition in 2022, breaking 100 units under one roof. But what I wanted to touch on is, even as the sophistication and maturity of my client base increased dramatically, I'd always encourage them to start with the gross income multiplier versus the capitalization rate approach. The capitalization approach is a much more accurate analysis of an asset's income producing capacity, but it's only accurate if all of the data points are correct. And so I think of the gross income multiplier as being 80% is accurate 100% of the time. And as I was coaching clients, I would say, start with the gross income multiplier because you're likely to get an accurate, be working with correct numbers. And I would agree with you, Rene, that's the back of the napkin test. And as that kind of pulls the pool of, say, of 100 offerings down to the 10 best ones, then I can help the principal and we really dive in and we start doing a full analysis on the capitalized true net operating income out of the asset. Even when I'm, as a principal, looking at entering or exiting a Plex property, I typically rely on the gross income multiple. And I find that the delta in the marketplace is fairly tight and fairly accurate. And part of the nature of the beast there is that you often just don't have as much data available out of the sales comps of 2 to 4 unit properties as you do on a $5 or $10 million listing. And so it's difficult to accurately capitalize a comparable sale if the broker or the principal hasn't advertised what's going on inside that income and expense statement.
Yeah, I would agree with that. What's one thing that you learned in your first couple of deals, especially residential? Because there are a lot of fix and flippers on YouTube and a lot of get rich quick, sales courses you can take. What's one thing that you learned that maybe made an impact in your profitability that you thought, wow, I wish somebody would have told me that, or I wished I would have seen that going into the deal? Did you have any life lessons like that? I call it tuition to life, but did you have anything happen like that?
I think there was a lot of them. I would say over time, I learned more and more that there's a blend of art and science to valuation, to understanding a project, and you have to develop both of those hands. You have to be able to analyze the numbers, and you learn through experience too, when you walk through a project, what type of resident it's going to attract, what type of discoveries are more likely, how big is the can of worms going to be once you start physically improving it and tearing it apart. And I think that is something you have to learn how to get comfortable with for yourself, that you won't be able to check every single box during your due diligence. And I got on this topic as you were talking about the residential transactions. And part of that might just be that was where I was at in the earlier phases of my career and investment cycle. But you have to learn how to roll with those punches, that you're going to acquire a property and you're going to discover there's more physical improvements that need to be done. And there's really nothing you could have done to quantify that out of the gate. And so you learn to build that into your overall business plan. Expect things to go wrong or more things to go wrong than you foreshadowed.
Welcome to real estate, right?
Exactly. I remember I've coached a lot of clients. It was clients at first, partners now. Most of my clients became partners in our real estate portfolio. But when you're having a really bad day or a lot of things are going bad in your real estate portfolio, the lemonade in that is, if it weren't that way, there wouldn't be such a capacity to generate as much wealth as there is out of real estate. If it was easy, like choosing to purchase and own Tesla or choosing to purchase and own Netflix, everybody would be doing it. So it's the yin and the yang of the industry. And that's the pep talk I give to myself.
That's awesome. So you specialize in repositioning underperforming assets. What are some of the top factors that you look for or look to in a property when you're trying to decide if it's a turnaround opportunity? And then maybe we can start talking about, how you're putting together your legacy fund and for investors and stuff.
Sure. It's helpful for me to use a live example. So I'll pick our more recent and larger acquisition, the Vicinity apartments in Corvallis. This is a 101 unit apartment complex. It's located directly contiguous to Oregon State University. So it's located right at the entrance of the university. And there's a common thread in value add acquisitions. There are value add assets. And I chuckled a little bit when I was listening to you speak to David Moore, Rene, when you were interviewing with him, because you kind of touched on this. And I mean this with no offense to any real estate investor, but usually a value add asset is value add because the asset's tired, and the asset's tired because the owner is tired. And this property fit that description wholly. The party that owned it had owned it for over 30 years, I guess almost 40 years, dating back into the mid 80s. They'd seen a lot of appreciation, both in the income stream that they were receiving from the property and the corresponding overall value. But it was a 70s built project. When they first acquired it, it was somewhere around its first 10 years into its physical lifespan. And now 40 years later, it's still a 70s built project. What we're looking for is the methodology and the philosophy is the same as flipping a home. A home is a consumer product. The value is a derivative of the utility that it provides to that consumer. And so when you're flipping a home, you're looking to most often create physical improvements to that property that is going to motivate a consumer to pay a higher value for it. And you're hoping that the cost of completing those improvements is less than the equity that is created, and that's your profit margin. When you're dealing with income producing assets, the loop is the same, but the value is a derivative of the asset's income producing capacity. The value that we put into the property is generally a blend between physical improvements and managerial improvements. And every property fits at a different ratio on that delta. I've made acquisitions that almost 100% is just improving management. It's understanding where those rents should be, getting the rents to that level on turnovers. But usually it's a blend of the two. And so the Vicinity project is a good example. It was averaging around $1,000 per unit for 2-bedroom apartments next to the university. And if we look at the average lease rate of 2-bedroom apartments at the time in 2022, it was probably around $1,300 per month. And so that is an opportunity. That asset is operating below average. And so the first thing we look at is, okay, what do we need to do to this property, both from a physical improvement standpoint and from an operations standpoint, the managerial side, to bring these units up to average. And when you take the $300 per unit delta and you capitalize it, again, just a rule of thumb, but in 2022, we were looking at about $15,000 in capitalized value per $100 in rental income. And so if your delta between where the rents are and where they should be is $300, you're looking at about $45,000 in equity that we believe we can realize per unit. And so then back to the original analysis, what physical improvements do we need to do that we can accomplish at less than $45,000 per unit? Because the difference there is going to be our profit. I have been a big fan of acquiring properties that are below average and repositioning them to average. And there's a lot of takers for average. And when I say takers, I refer to the resident base. And Oregon, as well as the nation, has been in a, let's call it an affordability crisis for a long period of time. And that's when I say I like that niche in the market because there's a lot of takers. The resident base is very liquid. Vicinity project in Corvallis had a couple of unique and valuable components. The first and most important is its geographic location to the university. So you don't have to stop at average, and we didn't on that project. So the first underwrite was getting us to average. Then we look at the property and go, well, is this an asset that can compete above average? And a nice way to think about this is new construction. The only way, new construction is expensive. Your development costs on a per square foot basis is substantially higher than something that's built 20, 30 years ago. And so if you're delivering a new project, like the 60 units, the Hickory Lake Apartments we just completed delivering in Lebanon, you're targeting the 100th percentile or above, right? So when somebody is looking at delivering a new project to the marketplace, they're going, all right, the average rents are $1,300 per month. The top rents, because not everybody's average, is $2,000 per month. And we're going to deliver this new project because we believe the market is ready to absorb it at $2,050. And so when there's the demand in the marketplace for that, new construction is feeding the top, which creates more space for average and below with the existing inventory. So with the Vicinity project, we have the geographic location. If you're going to go above average, the first thing you need to ask yourself is, do above average residents want to live there? And I mean that exclusively from an economic standpoint. They're not better or worse, but are there residents that are going to pay above average rents? Do they have a desire to live there? And we know the adage in real estate: location, location, location. And if you don't have a strong location, that's what people are paying for. So we knew we had that. We're located as close to the university as you can get. And then the physical product has got very good bones. It's a traditional 1 and 2 bedroom unit mix. I believe, I'm not as large of an authority on the U of O, University of Oregon marketplace, as I am Corvallis, though I believe they share very similar traits. And that is, in order to maximize the development code and the zoning code that is in place over the last 10, 15 years that developers have been delivering to those marketplaces, they've been delivering 4 and 5 bedroom units. And they're doing that because the zoning code might say you can only put 4 units on this lot, but you can put 5 bedrooms per unit and you're leasing it to students. 4 times 5 becomes 20 tenants. And so that's what I mean by bones, is that 1 and 2 bedroom units have been getting torn down so that 4 and 5 bedroom units can get built and leased on a per bedroom basis. And so to cut through and get back to Renee's question, the Vicinity was an asset that we were looking to reposition at about the 75th percentile of the marketplace. And so we got to take that a little bit further in where we can reposition that asset to. Our highest achieved rents in that project for the 2 bedroom, 1 bath units are now $2,250. So we've more than doubled the rents that were receiving when we acquired it in 2022. And the delta between what it costs us per unit to do that and the capitalized value that we created is very large. So it's a very profitable transaction. And being that it's a university project, it's a pro and con, particularly when you're in a rent controlled environment that we now are in Oregon. And particularly when you're doing a value add acquisition, I see it more as a pro. And that is that we realize a very high turnover rate during the tight summer window between school years. And that's another component you really have to think about when you're acquiring a value add property is, what's the business plan's life cycle? You're not going to do it over a 6-month period. And one of the things that we really liked about this project is, whereas often we're budgeting between 3 and 6 years to close that loop through natural attrition and turnover, unit projects that are appealing to the demographic of student housing, we've already turned in our between 3 school years over 80% of the units.
So let's break that down and talk about that, because investors love the idea of renovating stuff near campus, because if you think about it, your tenant base, like you said, they're turning over every late June. Typically, the property managers time the leases so that they turn over late June. The property managers got about 2 weeks to send their cleaning crew and their maintenance crew in to fix things before the new tenants take over, say, July 1st. The tricky thing about that is the lease up has already occurred in December prior to what the move-in cycle is. So when you're looking to renovate a campus project like that, let's say it's, 50 units, and if you went in and renovated all 50 units, you could substantially increase your rent, but you stand to miss that window for lease up. So how do you time that from an investor standpoint, in your opinion?
It was tricky. And I can speak to that on this project. So one, oftentimes you can create efficiencies through your trade relationships and the vendors that you work with. And the majority of our acquisitions have been in the 20 to 30 unit apartment size. And so that's the bulk of my portfolio. And we also, if you think about a 15 to 20% natural turnover rate per year, you're dealing with, maybe 3 to 5, 6 turnovers on that asset. And where that's relative is back to this timeline and the type of vendors that you can work with. So we realized one of our challenges on the Vicinity was we're going to need a higher caliber general contractor, both in their sophistication and their access to sub vendors. Whereas a lot of our general contractors are self-performing the majority of their work. And so we actually took some of those trade relationships and we rolled them forward into being sub vendors of the general contractor that we hired, who did do a great job. That was Bob Grant Construction in Corvallis. And the summer turnover season, these renovations started per unit on a 5 to 6 week schedule. And as we developed the relationship with the subcontractors and developed maximizing the efficiency and the scope of work, we were able to shrink that down substantially to about 3 weeks per unit. But these were real renovations, not just floor coverings and paint. We're redoing kitchens, we're redoing bathrooms. It is challenging. I always, when a lot of people, investors who aren't active in value add real estate, don't recognize that while you're working through that business cycle, it's self-inflicted volatility. If Peter was short-term and Paul was long-term, you're robbing Peter to pay Paul. So in the short term, you're creating downward pressure. And that downward pressure comes from you have vacancies for a longer period of time. Your maintenance expenses are, increased. So in the short term, the asset is, call it, underperforming from a practical standpoint. In the long term, that future income producing capacity takes a big step up and your profits are converted over into the form of equity, which is unrealized gains and has incredible tax treatment. And so for the Vicinity project, you hit on where our challenges were. And that is where it hit us the most, is that we could not pre-lease units, which is customary in the marketplace. You're not going to pre-lease all the units, but you're going to handle a lot of your absorption, knock it out for the next fall term before you get to the 11th hour of the summer turnover. And so you have a lot of students that are, you have a certain demographic of students. They're the early planners, and they're starting from the December of the prior year, through March, and they're executing for their move in late summer. And then you have a very large demographic of students that is still on top of it, but they're doing it midsummer when a lot of stuff is becoming available. And then you have your final bucket, and this is oftentimes foreign students that are coming into the school and they show up very late. That's kind of I'm trying to think of the polite word that's safe for the air, but the blank show that takes place right before school starts and everybody's fighting over the final remaining units. And so both of those, our lease up activity had to take place towards the latter part of that cycle because we're dealing with Oregon rent controls. So we can't force the residents out of units. That's not typically our practice anyway. We try to be reasonable landlords and deal with it through natural and inorganic turnover of the tenant base. And then we have to get their unit, and we need to, particularly the first year when we're really finding our stride and how long is it going to take us to turn each unit, after the first year's units were completed, we had a much better idea. Okay, it's going to take us 6 weeks or 4 weeks. And so now we're comfortable pre-leasing that unit. But we weathered through that. That's just part of the art and the juggle of working through value add acquisitions.
And you had mentioned that you really have seen like a 3-year progression to really see the renovations and the rents come up. Is that because you did them in phases? And so you're really seeing that now you're into that maybe third year, the majority of your units are renovated and you're elevating your rents?
Let me clarify that point. From 2022 to now, so 2025 in the fall, we'll start our next leasing cycle. So we're in the leasing cycle for the fall 2025 term. That the residents that we placed in 2022, their units were renovated and they were placed at our new benchmark for lease rate. But we didn't turn 100% of the complex. So in 2022, maybe it was 35 or 40%. And then in 2023, we actually, in full disclosure, in 2023, took a little bit more defensive approach because of the market cycle that we were in. We were coming into the credit crunch, liquidity was drying up. This asset was one of our very strong cash flow backbones. And as we're adjusting to the new cycle, and we can't just pull liquidity out of properties through refinance, we can't just pull liquidities out through sale. This isn't the only value add acquisition we're working through. That's what I mean by we took a defensive approach in 2023. We decided, let's not complete as many renovations this year. Let's focus on stabilizing that short-term net operating income in the asset. In 2024, we got back to business in a serious way again. So between those 3 years, we've turned over, meaning we have new residents in the complex, tenants in the complex. 80% of them are new since we acquired it in 2022. So it's not so much 3 years worth of rent increases, it's 3 years worth of, one way to think of a value add acquisition is almost like a miniature delivery. So in this apartment complex, we delivered 30 units, then we delivered 15 units, then we delivered 30 units. We still have 20 more to go that we hope to knock the vast majority out this summer.
Wow, that's super helpful for the listeners to kind of hear how to chunk it, so to speak, to do that renovation so you don't go 100% vacant. Because like Logan, when you miss that window for lease up, other than maybe the first semester in December after the first semester's over and you've got some tenants that are trying to relocate or move because they don't like the roommates. Other than that, most of them are locked into 12-month leases. So they're trenched in, and it's really tough if you miss that window to try to lease up and say, October. Once school starts, it's pretty hard to lease up. So it sounds like you guys had a great strategy in place. So I'm curious also on the cost to renovate, like a 1-bedroom unit, just off the top of your head, since you've done so much of this, do you have like a general number, like it costs $25,000, $30,000 on average when you're really going in and renovating, like you said, not just putting in new carpet and painting, but you're renovating a bathroom and a kitchen and everything else? Got a rule of thumb or just a number off the top of your head, how much that cost?
Yes, as an average and doing a good renovation, I would say right now, 2 bedrooms, we're around $25,000. And that does require a little bit of scale, but like we're actually under that benchmark at the Vicinity project that we used as an example. And renovations, just like every other segment of real estate and the economy at whole, the costs have increased dramatically just over the last 4 years. And I always think of it a little bit more on a per unit basis. The bedrooms don't affect it quite as much, just the size of the unit. Usually it doesn't matter how many bedrooms you have, you still have one kitchen. And it's your kitchens and your bathrooms that are going to cost the most. And then the size is going to dictate, total floor coverings, wall repairs, all of that good stuff. So each asset is unique, as we know, and the delta is going to be different for each property. But as a general rule of thumb, $25,000 to $30,000 is a reasonable target for a true total renovation that looks like a home that just got flipped, but is an apartment complex. And when you have a really large project, like the one we talked about, you get efficiency out of scale. And when you have a smaller project, you often need to find that efficiency through your vendor relationships. And so there's trade-offs there. We'll work with a different contractor when we're working on a smaller project. They might run a tighter markup. So they're doing it at less cost per unit, but then we also gave up the volume on it. And so it is part of the art of it in finding how to get that done efficiently. And if you're one of the benefits of being consistent in the industry for our vendors, we are not their highest profit point client with the greatest margin. In fact, we're on the tight side, and our philosophy or methodology has never been to, drive their costs down to where we're not a valuable client anymore, but we are consistent. And so through the credit crunch, a lot of our relationships, a handful of them date all the way back to the Great Recession. So good times and bad times and COVID, we're doing business. And so we, a part of our value proposition to them, construction and labor is a tricky industry to be in because you need people in order to take on good projects. But the business comes in and out the door like this. And so part of our value proposition to them is we're consistent. We keep you busy. It helps keep payroll consistent and the staff on. But in return, we require very efficient pricing. And we're the residual property management fee that goes into them. Somebody else serves as the brokerage fee, that is fewer and farther between, but oftentimes more profitable and kind of a sprint activity. So that's worked well for us. And it's just an ongoing continual effort.
That's great. Your Hickory Lake property that you've referenced in Lebanon, that's now fully completed and it's being leased up. Is that correct?
That's correct. We commenced on that project in March of 2024. So we just hit our 12-month anniversary. It's 60 units. It's my first ground up development. And we were originally scheduled for a June delivery. So we're a couple of months ahead of schedule. It's a 12-month delivery, which is not to toot my own horn, and I only get to do it in part, but that's a very efficient delivery. And so it was ahead of schedule and on budget. We didn't necessarily come in under budget, though we have the opportunity now to save that partnership some accrued interest if we can get it leased up and stabilized. So we started leasing units halfway through March, and we've, I believe, placed 6 tenants. So we've got 6 units leased at the complex, living on site and have pending apps. So where we're at, we're still pre-leasing season in my mind, even for, just middle market. This isn't student housing, but you typically in all housing, spring is your shoulder season and it progressively goes up. Summer is your prime season for leasing, and then fall is your shoulder season as well, and it slowly goes down. So we're quite optimistic that we'll have a good lease up and stabilization here.
Oh, that's great. Well, unfortunately, we're short on time. Logan, you're going to have to come back for a second round so you can talk about the legacy fund, because you're just a wealth of information. And I think the part that my listeners will really appreciate is you have been there. You've rolled up your shirt sleeves. You've slugged it out. You've renovated properties. You're not some dude that's learned it in a book or through a class, and now you're going to teach it and try to teach other people how to get rich quick. You've actually done it. And kudos to you. I mean, that's really impressive with what you've accomplished in your life. So will you come back for another round?
I appreciate that, Rene. Absolutely. I'm a hard learner. I actually did read a lot of it in a book, in books. And beyond that, I had a lot of great mentors that told me what to do and not do. But I tend to have to make the mistake myself, or it just doesn't resonate. I guess that's my way of learning. So it had a long time to get beat up quite a bit. But thank you for having me on.
Sometimes that tuition in life is painful, though, because it involves getting out your checkbook to solve something.
Yep. That's definitely the nature of the beast for real estate.
Yes, it is. Hey, how do people find you? How would people get in contact with you if they want to find out some more information about strategies for renovations. Again, you're going to come back and talk about your legacy fund, but how would somebody get in touch with you?
Yeah, the email would be the best way to get in touch with me. And that is Logan at SMI Fund Management.com. And we didn't get an opportunity to talk about SMI Fund Management today. We'll save that for another interview. I'd love to have me back on, but that is our syndication arm of the SMI family of companies. And that's our arm that we invite other investors to come in and partner on our deals with us. And that'll be the best email to reach me at.
Yeah, we're definitely going to have you come back and talk about that. And Brittany will put your contact information in the show notes also. Brittany, do you want to add anything?
I mean, I just really respect your story so much. I listened to your interview on Deal Junkies. Your story is incredible. I feel like I learned so much from you and your work ethic just from that 1.5 hour podcast. And I love your whole backstory and how you started really young, doing the chicken selling, the egg selling with your parents, and then slowly built your own business into the paintball industry and then got into real estate. I feel really connected in that way because I'm also sort of I have to make the mistake to know that it was the right one. And I've tried a lot of different things and I just really respected your work ethic and your entrepreneurial spirit. And it really encouraged me to keep going on that journey. And I mean, just learn so much from you. That was an incredible story. And I can't wait to have you back because I really want to hear more about the Fund Legacy organization. And I want to hear more about the deal you did with the U of O apartments, the 100 apartments. I know you said that was the most 1031 exchanges you did on a property, 9.
It was 9 properties with multiple tenant and common interests in them. So I think we had, I forget if it was 18 or 21 45-day identification ages to sign off on that transaction.
That's crazy.
Wow.
Yeah, I want to hear about that story.
Brittany, I appreciate you saying that. I'll look forward to telling you all about it.
Yeah, that sounds great.